The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody. Thanks for joining us for the first in our series of U.S. federal government contracting webinars Summer 2016 series. Today we are going to be covering the topic of maximizing the value of your government contracting business. My name is Jennifer Schaus, and I'm the host of this series. Today we are fortunate to have Eileen Peixoto with us, and Dan Duran was invited, but unfortunately at the last minute was unable to attend. So Eileen will be covering his content and slides. As I mentioned, this is a series, so as you can see over the next 2.5 weeks, we do have a variety of topics on government contracting. All of the webinars are complimentary and they are all being recorded. So in the event that you're unable to stay for the duration of the webinar today, you can certainly click back at the end of our series on June 17th and we'll have the links to all of the recordings. We will take your questions throughout the presentation, typically in the order that they're received. So on the right-hand side of your screen, you should see a control panel. One of the options there is questions. You type in your question, hit submit. Eileen will address your questions at the end of the presentation. So as we get started, I'll tell you a little bit briefly about myself and my background and my business. Eileen will introduce herself and also share some background information on Dan Duran. We'll get into the presentation, they'll make concluding remarks, and then cover the Q&A. We do have a full hour, so feel free to keep your questions coming in. In the event that we run out of time, we will have Dan and Eileen's contact information available. You can reach out to them directly. If there's a question that you don't feel comfortable asking, then certainly feel free to reach out to them directly. And we would ask that any cell phone and anyone else should please put their phones on mute. So a little bit about myself. I've been in government contracting for about 20 years. Started my career with Dun & Bradstreet in their government division, and we were selling credit reports and financial information to federal government agencies, whether it was GSA and contracting officers or intelligence agencies that were looking at white-collar criminals and money laundering. So more or less the government was looking at the Dun & Bradstreet information to ensure that the contractors had the financial strength to maintain the terms and conditions of the contract. I'm a member and frequent speaker at some of the government contracting organizations in town, and we'll leave that there. As far as my business, based in downtown Washington, D.C., and kind of been at this for about 10 years, we support government contractors with anything from proposal writing to business-to-government business plans, GSA schedules, and some of the certifications. In addition to that, we also host events for government contractors at the Kennedy Center in downtown Washington, D.C., which draws about 200 plus government contractors as well as federal government agencies and corporate sponsors. So enough about me. The real reason that we're here today is to talk about maximizing the value of your government contracting business. Again, Dan Duran of Quantive Business Valuations and Eileen Peixoto of Executive Council. So Eileen, I will now hand the controls over to you and let you take over this part of the presentation. Thanks again for joining us today.
Great. Thank you so much, Jennifer. And I'm really sorry that Dan is not able to be here. He is a valuation expert. His company is Quantive Valuations, and he works a lot in the M&A field, so he has a lot of hands-on experience with valuations for transactions, and that's really what our focus is going to be today, preparing your company to have the highest possible value for a transaction. I am a corporate lawyer. My background is in telecommunications, regulatory and transactions, as well as government contract legal advisory work. I've had a long career in private practice, but also have spent time in federal agencies, particularly the Federal Communications Commission, and I've been an in-house general counsel to an international telecom company. My focus in my practice is really working as an outsourced general counsel with small companies that can't really afford a full-time general counsel, but helping them assess the whole waterfront of legal issues that affect their business and bringing them the resources to address those problems. I mentioned that Dan Duran's business is Quantitative Business Valuations. They work exclusively on valuations and work on a whole variety of transactions for which valuations are important, which could be transactions and exit planning, but also for other purposes, including executive incentive compensation, such as stock options and estate and gift tax. My firm is a Executive Counsel PLC, is a small firm including all senior attorneys who have previously been general counsels in businesses, and we all practice as outsourced general counsels, providing senior level advice on demand as our clients need it. To get into the presentation on maximizing the value of your GovCon business, we're going to start with the financial considerations and some of the basic topics that Dan would cover. And the issue is how you assess the value of a company. And just a couple of preliminary comments about this. The focus of our presentation today really is about valuing your company or the issues that affect the valuation of your company in the context of a transaction. That's important because all of us tend to have an inflated sense of the value of our companies, and it's very important to realize that what we need to know is what the market, how the market would value the company, what an investor or buyer would consider to be the fair market value of a company. And in order to get to that point, we need to understand what the key value drivers are for a third party looking at the company. The most important initial driver is looking at earnings. Obviously, the issue is what kind of earnings do you have and how secure are the earnings going forward. And the valuation takes into consideration what the growth of those earnings is going to be over time, but balanced against the level of risk, the perceived value of risk. So it's the risk of what considerations need to be taken into account to assess the risk discounts that will affect the value when you're looking at earnings and growth. So these three drivers have a lot of interplay in determining a final valuation. There are many, many ways of coming up with a valuation. This is not my area of expertise, so I'm just reflecting some of the comments that I know Dan would make. But generally speaking, valuation is an assessment of value in terms of income. It can be in terms of income or the value that the market would place on the business or what the value of the assets are. But generally speaking, the usual way to come to a valuation is looking at earnings, and the most important number to look at is the EBITDA, which is the earnings before interest, tax, depreciation, and amortization. And the reason why we look at EBITDA is because that's the best way of comparing apples to apples. When you're looking at different companies and you're comparing profitability, you want a really clear view of the profitability of the company, and this is the measure that is considered to be most effective for that. And then there's usually a multiple applied, considering the growth balanced by risk that an investor might expect in the future. So the bottom line is that normally you would say more earnings, higher value, but you have to take into consideration the risk factors for growth as well. So it's important to understand that when evaluation is being done, the companies are evaluated by looking at their past performance. That's the only measure you really have, is the past performance and the projections for how that performance will continue into the future. But it's really almost a backward-looking process where you have to take account of where the company has been and where they are now, what that means for projections into the future. And so the multiple reflects what a reasonable estimate is of how the company will continue its earnings and its growth pattern into the future. And in looking at the balance of present earnings and what might be expected in the future, the key variable is risk. It's always a matter of pricing that risk. And in dealing with the pricing of risk, you have to remember that the higher risk is going to demand a higher return on investment. So any investor or a company that is a purchaser will factor in this risk by figuring out basically where their rate of return is, and that might, if it's a high risk, demanding a higher rate of return for the investor, it's going to yield a lower purchase price for the seller. In view of these interplays of earnings, growth, and risk, one of the most important things that companies can do to increase the value of their company, aside from earning more money, is to eliminate or mitigate risk. From the standpoint of Dan's practice in valuing government contracting companies, he's identified these several areas of highest areas of concern or risk, bigger discount factors for government contractors. He mentions lowest price technically acceptable proposals. This is a type of proposal that a lot of government contractors are required to use. I think that in some respects the LPTA measure is a little bit less relied upon than maybe previously, but it's still an area of risk if you're involved in those kinds of proposals. The set-aside small business special certifications are also a risk. For the 8As, there's a schedule for transitioning to commercial projects that forces 8A companies to get out of the set-aside arena, and that will help them present themselves in a less risky posture in the future. Other special certificated companies don't necessarily have that transition schedule or requirement, and it may make them a riskier investment if they remain small and remain overly reliant on small business set-asides. The thin management is obviously a problem with small companies. Small companies can be mom and pops. They can rely upon family members. They can rely upon a single key manager. Those are also big risk factors. The ability to capture opportunities in your business development acumen is another area of big concern, and certainly low margin, low skill work. You want to be more unique, more capable, more extraordinary in order to get higher value. Dan is fond of saying that there's no such thing as an average company. Everybody is different. There are many, many factors that come into play. So you do need to rely on the help of professionals to find those areas where you are unique, things that you can focus on that allow you to manage the risk more effectively, to move you off of the average part of the bell curve and into a higher risk profile. So from a legal perspective, I want to focus on the risk factors and what companies can do from a legal perspective and with their legal infrastructure to minimize a lot of the risk factors that might come into play when you're going into a transaction. The first thing to be very aware of is that, as Dan said, is an issue of how the company is positioned currently and how it's taken care of business over the past on the one hand, and then looking forward to the opportunities for growth in the future. So you need to make sure that your current legal risk variables are well in hand and controlled, and so you can focus on your contract vehicles, protecting your assets, making sure you have adequate corporate control button up all of your current assets and control factors now so that you're minimizing risk in the present. And then you have to anticipate future risk, and you have to be sure that you have in your charter documents, in your agreements among partners or shareholders, and in your contracts, effective rules that allow you to manage change in a way that minimizes your ongoing risk. I want to talk a little bit first about what I call an identity crisis of companies, and this has to do with making sure that you are in control of what you are. This is what a purchaser or an investor would be looking at you for. And the value in your company is going to largely be in your intellectual property, in your competitively sensitive information, in your reputation. And you need to make sure that you're not losing control of those assets and features inadvertently or just by not paying attention. So you need to make sure that your intellectual property is protected, and that involves taking care to ensure that you're not infringing some other party's intellectual property, but also that you're doing the right thing to maintain your rights and your copyrights, trademarks, and patents if you have them, so that you're not going to be infringed upon. And that also includes doing routine audits of how secure your intellectual property is, and Googling yourself and figuring out who might be out there infringing your intellectual property. You want to make sure that you have very strong non-disclosure agreements or confidentiality agreements with everybody, with all of your business partners, with all of your customers, joint venture partners, teaming partners, your employees, whoever is doing business with you, so that you make sure that all of your confidential information is adequately protected and your trade secrets are not infringed upon. And also you want non-disparagement clauses with your key employees as well as your partners. You don't want to be in a position where you have a disgruntled employee who's out there bad-mouthing you. This next slide has to do with not just what you are, but who you are. And I called this the house of cards because you need to make sure that your corporate identity, your liability shield that's embedded in your corporate identity are intact, that your SBA size certification is not somehow undermined, and that you're not running the risk of violating the ostensible subcontractor rules or any other problems with affiliations with team partners or joint venture partners that could put you at risk for losing your size certification or even getting into a situation of fraud or debarment. So here you have to pay very close attention to corporate formalities. If you have a small company, you have to make sure that you follow good corporate practices and keep your business separate from your personal affairs, that you document everything, keep your corporate charter documents in good order, and that you treat the corporate form seriously. If you don't, then there's a risk of what they call piercing the corporate veil and looking behind the corporate form and getting to you personally for liability. You want to be very careful about interlocking directors with other government contractors that might wind up creating affiliations or size problems for you. You want to make sure that your governance is transparent, that you're in compliance with all regulatory requirements, which is not only SBA, but depending upon what your business is, there may be other special industry-specific regulations you have to comply with. And very importantly, you have to make sure that you maintain proper classification of your employees. This is the issue of whether you treat somebody as a W-2 and withhold their taxes, or if you are able to treat them as an independent contractor and give them a 1099 at the end of the year. This comes up very importantly when you're dealing with work share. Small businesses acting as primes must have must perform at least 50% of the contract with their own employees, and that really means employees. It really means W-2 employees, and a lot of people try to meet that requirement with 1099s, and that runs a big risk. The next area of concern is what I call backdoor break-ins, but this is really otherwise known as keeping the cash. You don't want to run the risk that any of the cash that you're expecting to get from running your business is going to be lost due to third-party claims or any kind of unforeseen liabilities or costs or lost revenues. And the most important way of plugging up this hole is making sure that you have very strong contracts and that you pay very close attention to indemnities, damage and warranty exclusions, liability limits. These are provisions in contracts that make a lot of people glaze over, but they're very, very important in terms of balancing the risk between you and the other party. And you want to deflect as much liability and risk from yourself as you possibly can. And the risk that you can't deflect, you have to have other means of covering, whether it is legal recourse against other parties, slowing down the warranties or the indemnities, or having adequate insurance. And you also want to make sure that you have a business continuity plan so that if there is anything from losing the eligible shareholder who keeps your company qualified under a special SBA certification, or whether it is losing control of a particularly important asset or intellectual property. There are a number of things that could really, in a very unexpected way, cause great concern or even damage to your business and your ability to continue your business, and you want to have a backup plan. And then there are bad breakups. Nobody wants to think about this up front. Everybody hopes that everything goes well with business partners and with the personnel that they have painstakingly reviewed and vetted and hired. But there are always problems, and when somebody leaves or when there is partner fallout, you want to make sure that you're in control of how that process occurs and what the consequences are. And you want to make sure that the rights and obligations of each party are very clear, and that you're not leaving yourself open to unanticipated claims to the extent that you possibly can. I want to make a little note here that a lot of people don't really understand, is that in many jurisdictions, minority equity holders are owed a fiduciary duty by majority equity holders. So if you have a minority equity partner that leaves the company or doesn't agree with the way the company is being managed, that minority party can file a lawsuit and challenge the decisions that you've made, and that's another big risk for companies. So you want to be sure that you understand who holds equity in the company, that the equity holders are people that you really trust, and that you understand what to do if and when there's a claim from a minority equity holder. So some of the other fixes here are making sure that you have non-solicitation and non-compete agreements in place, that you, as I said, know who your equity holders are, that in the event of a breakup that requires a buyout of one partner to the other, that you have a way of dealing with the valuation. And you can even have agreements about the type of valuation formula or even agreed valued numbers that will come into play in certain events where you need to deal with buying out one of your partners. And you also need clear rules for those kinds of situations, and not just a voluntary separation, but death and disability, bankruptcy, other, numerous types of events that can happen to create a change in the ownership of a company. And then you want to make sure that you're prepared for litigation. In this regard, making sure you're not inadvertently giving up attorney-client privilege on important documentation, that you maintain documents for periods that may be required by law or by contract, but that you don't retain documentation that you don't necessarily need that might wind up in litigation. Finally, just a word about stumbling blocks. This is all about keeping yourself attractive to investors or purchasers. You don't want to create any disincentives or big discounts in evaluation that looks at how hard it might be to gain control of your company. And this means limiting preemption rights of various partners or equity holders so that a new investor or a new purchaser has a big hurdle to crawl over in order to get control of the company. You want to make sure that there are drag-along rights so that the minority owners can't object if you want to effect a sale or a merger or any other kind of a transaction. You want to make sure that your contracts are easily assignable and that you don't have to go around getting permission from everyone that you have a contract with in order to assign that contract, and that you make sure that your corporate culture is amenable to change and to evolution. A hidebound corporate culture is not going to be attractive to somebody that wants to merge with you or acquire you. So that's the end of the actual main presentation. Just a couple of conclusions. From the financial standpoint, it's most important to address risk in your enterprise and to do whatever you can to eliminate that risk and make it possible to push your growth yields so that they give you the biggest value enhancement. And from the legal standpoint, the critical things are to make sure that you have your legal infrastructure in good order and that you don't allow the value of your company to leak out unintentionally because of poor attention to corporate details or contracts or transactions or your relationships with your partners or employees, and that you maintain clear rules to live by so that you preserve not only your current revenue but also your future growth opportunities. So with that, we can go to questions and answers, and Jennifer, I will turn it back to you.
Great. Thank you so much, Eileen. That was very informative, especially in the short amount of time that we had, and great information. So thanks for sharing with us. So we'll answer the questions in the order that they were received. And the first one reads, is there a need for a formal valuation, or can I simply use a reasonable multiple?
Well, there are many ways of performing valuations and many costs, very different cost profiles of different types of valuations, and I understand that in some cases, for example, to do a valuation for a buy-sell agreement, you may not want to spend the kind of money that you might need to do a valuation in the case of a purchase or sale of the business. But in all cases, as I said at the very beginning, it's very important to get that third-party perspective on what your company really could be valued at in the market, rather than using your own assessment of your own value, because we all have a skewed perspective on our own companies. So whether it's and there are many ways of getting kind of, I wouldn't say quick and dirty, but you know, valuations that don't cost a lot of money. There are insurance companies that do valuations, there are accounting firms that do valuations, there are specialists that do valuations, and there's a large range of the prices of valuations. But in any case, I would go for a third-party valuation rather than relying upon my own assumptions.
Great. And the next question here, what's the best valuation technique to use?
Well, as Dan would say that you know, there are many variations of valuation techniques, and some are better suited for different types of companies and different types of transactions than others. And it's important to know that when you have a closely held company and they're in really market value because you don't have stock on the market that's got a price, there will be ways of figuring out fair value, which isn't the same as fair market value. It takes into consideration discounts that might apply because of the different roles of different partners that have different shares of interest in the company. So I would say the first thing is to look at the right type of valuation technique for the size and posture of your company. And if you're a small, closely held company, then you might do just a simple earnings multiple, but again, it depends upon who you are. So if it's a valuation that is in the context of a buy-sell, that might be different than the valuation that you use if you're selling to a third party. So I would say work with your financial advisors and with your legal team in advance and think about the different types of contexts in which a valuation might need to be done and figure out what the most reasonable methodology is for your type of company in these various circumstances. And so there really isn't one best type of valuation across the board. It really is very fact and circumstance specific.
Great. And the next question here is, there are a lot of commercial legal documents on the internet. Are they safe to use?
Well, I love this question because I have had much experience with many clients who have, at least in the early days of their corporate life, they've downloaded documents from LegalZoom and other web resources, and anything from an operating agreement for an LLC or a shareholder agreement to an employment agreement or a partnership agreement or a confidentiality agreement, buy-sell agreement, rather than paying to have somebody prepare them for them. And more often than not, they're doing themselves more harm than good. And I would say that there are very few documents that I find on the internet that really are good documents, but none of them can be applied without modification to your own individual circumstance. Everything has to be customized. So if you think you will save money by downloading a document, as a starting point, at least get that document reviewed by an attorney, a qualified attorney, who can customize it for your purposes. Otherwise, you run the risk that it's a lot better for the other guy than for you. And you want to make sure that those critical legal factors that allocate risk between you and the other party are working in your favor and not against you.
Great, makes sense. So it sounds like they do need to be customized. Question here says, can a stock corporation get a higher valuation than an LLC?
I think there's a lot of misconception about the differences between corporations and LLCs in the context of how you grow your company, how you attract investors or purchasers. In fact, LLCs are very fine vehicles and are in some ways even more flexible than the corporate form and can be more efficient in a lot of ways. Corporations, stock corporations, come with a lot of existing rules and statutory guidelines, a lot less uncertainty. A lot of the ways in which stockholders relate to each other, management relates to stockholders, the rights and obligations of directors and officers, and how you can issue stock and develop new classes of stock, all those kinds of things are pretty well prescribed in the law of the jurisdiction of formation. With LLCs, there's just a lot more flexibility. The parties have to define those rights and obligations themselves in their own charter documents, which is an operating agreement. And because in an LLC it's much more clear that you're always dealing with a portion of 100% of the equity rather than shares of stock, you have to think about how you deal with dilution of ownership in different ways. But all of that said, all of these issues are very manageable, and I know many companies that have reached very large scale and have many investors and have done many transactions very successfully that are LLCs. So I would say that the choice of whether you use an LLC or a stock corporation will depend upon a number of factors, but none of those will really have to do with the valuation of the company. So either form is equally good in terms of attracting investors and purchasers, as long as the other legal infrastructure issues are taken care of. It's not a matter of the form of the company itself, it's a matter of all the other issues that we've already talked about.
Great answer. So yeah, it sounds like it needs to be customized, just like the legal documents, and not a cookie cutter answer there. Another question here says, should we formally register our IP, intellectual property, to protect it?
You don't have to. It's a good idea, but what registration gets you, particularly with copyrights and trademarks, is that it removes any uncertainty that you have prior right to that intellectual property. So all the registration really does is confirm and make apparent to the public that you were the first to use that mark or that expression, and that you have prior rights over and above anybody else. But as a legal matter, in copyright and trademark, you have the protection as long as you have been the first to use it, and you can prove that. And with copyrights, it's best, although not absolutely necessary, but it's best to include the copyright notice so that you make clear that you're putting the public on notice that you claim a copyright to that material. You can do the same thing for a trademark by using the TM symbol next to whatever it is that you're claiming a trademark for. And that puts everybody on notice that you're claiming priority rights to those marks or expressions. If you get into litigation, if you have not registered and there is an infringement suit, then you would have to go to court and prove that you were the first to use that expression or that trademark, which means that best practices are that you keep samples in your file of the use of these trademarks and copyrighted material with dates on them. So whether it's an invoice or a press release or a letter or some other kind of communication that have a verifiable address on it that will attest to the date that you first used it, then that will be effective proof in court. If you have the registration, you don't need to make that proof. The registration will make that proof for you. Registration of trademarks can be an expensive and time-consuming process, so no one wants to go through that. You have to do extensive trademark searches of both registered and unregistered marks at both the federal and the state level, and you have to go through a vetting process with the Patent and Trademark Office, which can be extensive. But for people who really put a lot of value in their trademarks, that's a process that's worth going through.
Great. You talked about proper employee classification. Does this mean our employees that have top secret clearances versus those that do not, or can you elaborate on what this means exactly?
Well, it doesn't have anything to do with top secret clearances, but it has to do with whether an employee, whether a person is really under your control and working for you under your guidance and management and oversight, and if they are, then they're typically an employee. There's a lot of litigation in many industry segments about whether people are employees or not. There's a lot of very public litigation going on now with Uber, and there's been a lot of litigation in the past with companies like FedEx and UPS, where individuals are required to adhere to certain protocols or procedures, or even wear certain uniforms, but they have to put their time into the company timekeeping system. They might get a salary. There's a lot of different indicia to tell you whether a person is better classified as an employee or a 1099. But I just raised this as a red flag because the IRS has been very concerned about this. And in industries like government contracting, where the classification of employees versus contractors may be very relevant and visible, a visible issue, then companies that don't have the right classification run the risk of having the IRS inquire and look more closely at whether the classifications were inappropriate. And if they're not appropriate, and if you've called somebody a 1099 when they really should have been a W-2, then you risk not only having to pay back withholding taxes and other payroll taxes, but possibly a lot of fines as well. So this is just another issue to review with your attorney and make sure that you are on the right side. The indicia for making the right classification can be a little bit confusing and a lot of gray areas, so you do want to get some help in making that decision.
Great information. We still have more questions coming in, so please continue to send your questions in. We still have about a good 20 plus minutes, and I'll continue to read these in the order that they came in. Okay, Eileen, you mentioned contract indemnities, damages, and warranty exclusions. Why are these important? Aren't these simply boilerplate?
They are boilerplate, but the devil is in the details. And let me talk about warranty exclusions first. There's something called implied warranties. This comes up a lot when we have products, not so much services, but even though, you might say, you might have stated in various contracts certain warranties that you're giving to a customer or another party, you may, unless you explicitly exclude them, you might also be subject to implied warranties. These implied warranties are mainly merchantability and fitness for a particular purpose, meaning that you're selling something that meets the standards and qualifications of an item that a normal purchaser would expect to find, and that it's not violating or infringing upon the intellectual property rights of any third party. So those are the main implied warranties. And what you want to do is make sure that if you're not accepting implied warranties or any other warranties that you think that the purchaser may be expecting, you want to state very clearly that the only warranties you're giving are the ones that you've set out in the document, and that everything else is excluded. So that's one example of how you can get caught losing value by being subject to warranties that you're not even aware of. With indemnities, is a very big issue. A lot of people misunderstand what an indemnity is, but classically an indemnity is an agreement to cover the other party for losses due to a third-party claim. So if something goes wrong between two parties to a contract, an indemnity comes into play if there's a third party, whether it's an end user of a service or some other, maybe even a third party whose intellectual property rights are infringed or has some other interest in what has gone on between the two primary contracting entities. The third party will lodge a suit against party A, but under the contract, party B, who's been responsible for, maybe providing the service or providing the technology is obligated to indemnify Party A for all the losses that Party A experiences because of this lawsuit from Party C. An indemnity is not intended to be a guarantee of coverage of damages directly between Party A and Party B. That's a misuse of the concept of indemnity. And normally, if one party to a contract is damaged by something the other party does, they have to go to court and prove not only causality but the extent of the damages. So you don't want to give up your right to require the other party to have to prove their damages in court, unless it's a valid indemnity against a third-party claim. So there are all kinds of ways of limiting indemnities. Some indemnities require that the indemnifying party actually defend the lawsuit brought by the third party. Some of them don't. Some of them just require that the indemnifying party pay for the damages. Some indemnities allow you to recover certain expenses. Some of them don't. Some of them are qualified or dependent upon the indemnified party providing early notice or adequate timely notice of a third-party claim. So there's all kinds of ways that you can qualify an indemnification to limit your risk. You want to get the right indemnities from the other party, but you want to limit your own indemnities to the other party. So that's why you have to be very careful about that particular area. And then in terms of damage limitations, there are different types of damages. There are direct damages and consequential or indirect damages. And indirect damages are things like lost profits or lost opportunities or lost reputation. And indirect or consequential damages can be very difficult to quantify, very difficult to control. So you want to be sure that you limit those kinds of damages and when they can come into play. And if possible, you want to limit your damages to a dollar number or even have liquidated damages so that you don't have uncertainty about the amount of exposure that you have under a particular agreement. So those are just some of the things that come up in these sort of mind-numbing boilerplate terms, but it's very important to pay close attention to them because they can mean a lot of money in the long run.
Great, good information. It looks like we've got 2 more questions that just came in, and we've got about 10 minutes left, so we can try to squeeze these in. First one says, how much insurance is adequate to have for a small business government contractor?
It's very difficult to come up with a particular number, but I would say that there's some kinds of insurance which a lot of companies forego, which they should have. Most companies will wind up with a general commercial liability policy, but some of the, particularly for government contractors in the service business, you'll want to have professional liability insurance or errors and omissions insurance. So this will cover you for mistakes that you might make in your area of supposed professional expertise. So you want to be sure that you have some way of, this is like analogous to a lawyer's malpractice insurance or a doctor's malpractice insurance. You want to make sure that you're sued because you've given a customer an expectation that is not met, that you have some insurance coverage for that. It depends on your area of expertise and your business, but you might also want cyber liability insurance. This is particularly important in the software arena or for services, telecommunications, and IT services that have exposure to cybersecurity issues, and there are policies out there for cyber liability. You also want to be sure to have, if you have a good number of employees, you want to have employer's liability insurance to protect you against certain kinds of employee claims. And you want to have a good umbrella liability policy as well, so that you have additional coverage that might be, on a per occurrence basis under your general commercial liability policies. Even above and beyond these liability policies, you want to look at your life insurance policies. If you have partners who are critical to the operation of the business, you want to be sure to have key man insurance on that person. And if you have a small company where there's a buy-sell agreement to cover buyback of equity in the case of death or disability, or even a deadlock or decisional deadlock, then you want to have life insurance policies on each of the major partners. So rather than giving you a number of how much, I would suggest that you look at and get good advice on the different types of insurance that you might need to cover your company.
Great, and we'll try to squeeze this last one in. You and business continuity plans, can you please elaborate on what those are?
Well, business continuity plans look at possible disasters and develop the Plan B and Plan C in the event of those disasters. So, as I mentioned, you have to look at where your money is coming from, and the typical one for a government contractor really is being reliant upon a particular individual in the company that is qualified for a certification. So you have 8A, or you may have a service disabled veteran or some other qualified individual, and if there isn't anyone to take their place in the event of death or disability, or even business divorce, then contracts can evaporate. So you need to figure out whether you're going to have to retain that classification by having somebody identified who can take their place with the same eligibility, or whether you're going to replace that contract with a different kind of contract. So that's like the major concern that I would have. But business continuity can be concerned with everything from loss of the ability to use a particular technology in the case that a technology you are reliant upon becomes unavailable because of a patent lawsuit, for example. What are you going to do if you don't have access to that technology? So it's really thinking through the critical aspects of your business that if you lost them, you would have a huge impact on your revenues, and figuring out what your Plan B is.
Great, that was fantastic presentation, good audience participation, really insightful questions, and enjoyed listening to your answers as well. So thanks again, Eileen, for participating. I'm just going to move on to the next slide, which gives a full list of the webinars that we're covering and the links to get to those. Again, they're all complimentary and they are all recorded. In the event that we weren't able to get to your questions today, go back to Eileen's contact information. You can feel free to reach out to her directly or Dan. Otherwise, we want to thank everybody for joining us today and hope that you will join us for a future webinar. Eileen, again, appreciate your time, and any last thoughts that you wanted to share with our group.
No, I think we've covered a lot of ground, and I'm happy to answer anybody else's other direct questions, but I really appreciate the opportunity to provide this presentation. Thank you.
Great. Thanks, Eileen, and we'll conclude here.